Can AI predict market crashes? Forget crystal balls. The future of finance might just be coded. We're on the cusp of an AI revolution that could fundamentally change how we understand and react to market volatility. But can these powerful algorithms really pinpoint the exact moment a financial tsunami is about to hit? Prepare to have your mind blown. Picture this. It's Monday morning, you're sipping your coffee, checking your portfolio, and everything looks perfectly normal. The market's opened stable, your investments are humming along nicely, and then, boom. By lunch, billions of dollars have evaporated. Sound familiar? It should, because this scenario has played out time and time again throughout financial history. But what if I told you that while you were sleeping, artificial intelligence was already crunching through millions of data points, social media posts, economic indicators, and trading patterns, looking for the subtle signs that something catastrophic was about to unfold? What if the technology we carry in our pockets could potentially warn us before the next financial earthquake hits? Now, I want to be clear from the start. We're not talking about some magical fortune-telling machine here. The relationship between AI and market prediction is far more nuanced and fascinating than any simple yes or no answer. But the implications of what's happening right now in the intersection of artificial intelligence and financial markets are absolutely staggering. Before we dive deep into this rabbit hole, let me tell you something. If you're the kind of person who likes to stay ahead of technological trends, who wants to understand how AI is reshaping our world, then you're going to want to bookmark hotbot.com. It's become my go-to resource for cutting-edge AI research and staying updated on the latest developments in machine learning. Trust me, you'll thank me later when we start getting into some pretty complex territory. So let's start with the Holy Grail itself. Why is predicting market crashes considered the ultimate financial superpower? Think about it this way. If you could reliably predict when markets were about to tank, you wouldn't just be rich, you'd essentially have godlike powers in the financial world. You could protect entire economies, save people's retirement funds, prevent global recessions, and potentially avoid some of the most devastating economic disasters in human history. The human cost of unexpected market downturns is absolutely staggering. We're not just talking about numbers on a screen here. We're talking about real people losing their homes, their savings, their entire life's work in a matter of days or sometimes even hours. The 2008 financial crisis alone wiped out approximately $16 trillion in wealth in the United States. $16 trillion. That's more than the entire GDP of most countries. But here's what makes it even more heartbreaking. Many of these crashes don't happen because of some inevitable economic law. They happen because of fear, panic, and the very human tendency to follow the crowd off a cliff. When people see others selling, they sell. When they see markets falling, they assume the worst and make it worse. It's this psychological component that makes market prediction so incredibly difficult and so incredibly important. Let's take a quick trip down memory lane and look at some of the most unpredictable market shocks in recent history. Black Monday in 1987 saw the Dow Jones drop over 22% in a single day. Nobody saw it coming. The dot-com bubble burst in 2000, wiping out trillions in tech valuations, as investors suddenly realized that companies with no profits probably shouldn't be worth billions. The 2008 subprime mortgage crisis brought the global financial system to its knees when it became clear that giving mortgages to people who couldn't afford them wasn't sustainable. And more recently, the COVID-19 pandemic caused some of the most volatile market swings we've ever seen, with the market crashing and then recovering in ways that defied all traditional logic. Each of these events had warning signs, but they were buried in an ocean of data that human analysts simply couldn't process fast enough or comprehensively enough to see the full picture. And that's where artificial intelligence enters the story. Now here's where things get really interesting. AI doesn't just excel at processing data, it's absolutely mind-blowing at it. We're talking about algorithms that can analyze millions of data points per second, identify patterns that would take human analysts months or years to spot, and do it all while you're sleeping. Think about all the information that could potentially signal a market crash. Economic indicators like GDP growth, unemployment rates, inflation data, corporate earnings reports, debt levels, cash flow statements, social media sentiment, news headlines, political developments, interest rates, commodity prices, currency fluctuations, consumer confidence surveys, retail sales data, manufacturing indexes. And that's just scratching the surface. For a human analyst, trying to keep track of all these variables simultaneously would be like trying to solve a Rubik's Cube while juggling flaming torches. But for AI, it's just Tuesday. These systems can ingest vast amounts of structured and unstructured data, process it in real time, and identify subtle correlations that no human brain could possibly detect. Let me break down how these AI algorithms actually work, because understanding the technology is crucial to understanding both its potential and its limitations. At the most basic level, we have machine learning algorithms that can identify patterns in historical data and use those patterns to make predictions about future events. These systems learn from experience, getting better and more accurate over time as they process more information. Then we have deep learning networks, which are inspired by the way the human brain processes information. These systems use layers upon layers of artificial neurons to identify increasingly complex patterns. A simple machine learning algorithm might notice that when unemployment rises, markets tend to fall. But a deep learning network can identify much more subtle relationships, like how the combination of rising unemployment, specific types of social media sentiment, particular patterns in corporate earnings guidance, and certain geopolitical events might signal an impending crash. Neural networks take this even further, creating systems that can process multiple types of data simultaneously and identify nonlinear relationships that traditional statistical methods would miss completely. These are the kinds of systems that can spot the early warning signs of a market crash hidden in the noise of everyday financial data. But, and this is a big but, successfully identifying patterns in normal market conditions is very different from predicting catastrophic crashes. And this brings us to the reality check portion of our journey. Here's the thing about markets. They're not just driven by economic fundamentals and rational decision-making. They're driven by human beings. And human beings are beautifully, maddeningly irrational. Fear and greed don't follow mathematical formulas. Panic doesn't respect statistical models. And market crashes often happen not because of any fundamental economic reason, but because of pure human psychology. Think about it this way. AI can analyze all the data in the world, but it can't predict when a single tweet from an influential person might trigger a massive sell-off. It can't foresee when a completely unexpected geopolitical event might cause global markets to panic. It can't anticipate when investors might suddenly lose confidence for reasons that have nothing to do with underlying economic conditions. This is what we call the black swan problem, named after the concept popularized by Nassim Taleb. These are events that are extremely rare, have massive impact, and are only predictable in retrospect. The September 11th attacks, the COVID-19 pandemic, the collapse of Lehman Brothers. These were black swan events that no amount of historical data could have predicted. And here's the fundamental limitation of AI. It learns from historical data. If something has never happened before, or if it happens in a completely new way, AI systems built on historical patterns might be completely blind to it. It's like trying to predict the next color of the rainbow by analyzing all the rainbows that have ever existed. You might get pretty good at predicting the usual colors, but you'll be completely unprepared if nature suddenly decides to throw in a new color you've never seen before. Then there's the data quality problem, which is absolutely crucial to understand. AI systems are only as good as the data they're trained on, and financial data is notoriously messy, incomplete, and sometimes deliberately misleading. Companies can manipulate their earnings reports. Economic statistics can be revised months after they're initially released. Social media sentiment can be artificially influenced by bots and coordinated campaigns. But here's where things get really interesting, and where the future of financial AI is actually heading. Rather than trying to build AI systems that can perfectly predict market crashes, the financial industry is moving toward a hybrid approach that combines AI's incredible data processing capabilities with human insight, experience, and judgment. Financial institutions around the world are already using AI not as crystal balls, but as incredibly sophisticated early warning systems. These systems don't say, the market will crash on Tuesday at 2:17 p.m. Instead, they say things like, based on current patterns, market volatility risk is elevated, or sentiment indicators suggest increased probability of significant market movement in the next 30 days. JP Morgan Chase uses AI systems to analyze news flow and social media sentiment to gauge market mood. Goldman Sachs employs machine learning algorithms to identify unusual trading patterns that might signal market stress. The Federal Reserve uses AI tools to process economic data and help inform monetary policy decisions. But in every case, these AI systems are tools that augment human decision-making rather than replace it. The algorithms can process data and identify patterns, but human experts interpret those patterns, consider context that the AI might miss, and make the final decisions about how to respond. This human-AI collaboration is where the real magic happens. AI can spot subtle patterns in massive data sets that humans would never notice. Humans can provide context, make judgment calls, and adapt to novel situations that AI systems aren't prepared for. Together, they create a more robust and reliable approach to understanding market risks. For individual investors, AI-powered financial tools can be incredibly valuable for research and analysis. Platforms like those you can find through hotbot.com can help you access AI-driven market analysis, research reports, and trend identification tools that were previously only available to institutional investors. These tools can help you identify investment opportunities, understand market sentiment, and make more informed decisions about your portfolio. But, and this is crucial, use these tools as part of a broader investment strategy, not as a replacement for your own research and judgment. AI can help you identify patterns and trends, but it can't tell you what those patterns mean for your specific financial situation and goals. It's also important to understand the difference between predictive power and probability in financial AI. When an AI system says there's a 70% chance of a market correction in the next 6 months, that doesn't mean the correction will definitely happen, and it doesn't mean you should panic and sell everything. It means that based on current data patterns, the AI estimates that market conditions are more likely to lead to a correction than not. Think of AI predictions like weather forecasts. When the weather app says there's a 70% chance of rain, you don't cancel all your outdoor plans forever. You carry an umbrella and make informed decisions based on the probability. The same principle applies to AI-powered financial predictions. Diversification remains one of the most important principles of investing, regardless of how sophisticated AI predictions become. No AI system is perfect, and markets can always surprise us in ways that no algorithm anticipated. By spreading your investments across different asset classes, sectors, and geographic regions, you protect yourself against the possibility that any single prediction might be wrong. Looking toward the future, continued advancements in AI will undoubtedly change the landscape of investing and market analysis. We're already seeing the development of more sophisticated natural language processing systems that can understand context and nuance in news and social media data. We're seeing improvements in real-time data processing that allow AI systems to react to market changes almost instantaneously. But even as these technologies advance, the fundamental challenges we've discussed, human irrationality, black swan events, data quality issues, will likely remain significant obstacles to perfect market prediction. The future probably won't bring us AI systems that can predict market crashes with perfect accuracy. Instead, it will bring us increasingly sophisticated tools for understanding market risks, identifying potential problems before they become catastrophic, and making more informed decisions about how to protect and grow our wealth. The key for individual investors is to stay informed about these technological developments without becoming overly dependent on them. Resources like hotbot.com can help you access the latest research, analysis, and tools that can inform your investment decisions. The key is to remain curious, stay informed, and always remember that in the end, the most important factor in your financial success isn't predicting the next market crash. It's making consistent, informed decisions that align with your long-term goals and risk tolerance. The AI revolution in finance is just beginning, and while it may not give us the crystal ball we've always dreamed of, it's already providing us with tools and insights that were unimaginable just a few years ago. The future of finance is being written right now, and artificial intelligence is holding the pen. But ultimately, you're the one who decides what story gets told with your money.